The impact of inflation expectations on interest rates and bond yields. Inflation expectations play a crucial role in shaping financial markets, particularly influencing interest rates and bond yields. Understanding this dynamic can help investors make informed decisions and better anticipate market movements. This article explores the relationship between inflation expectations, interest rates, and bond yields, providing insights into how these elements interact in the economic landscape, how inflation expectations influence interest rates. When inflation expectations rise, central banks often respond by increasing interest rates to prevent the economy from overheating. Higher interest rates make borrowing more expensive, which can cool down consumer spending and business investments, thereby helping to control inflation. Conversely, if inflation expectations are low, central banks may reduce interest rates to stimulate economic activity. Example, if investors expect inflation to rise from 2% to 4%, the central bank might raise the federal funds rate to curb potential inflationary pressures. This increase in interest rates makes loans more expensive, reducing consumer and business spending, and thus slowing down the economy to keep inflation in check. The relationship between interest rates and bond yields. Bond yields are closely linked to interest rates. When interest rates rise, the yields on existing bonds tend to increase to remain attractive to investors. Conversely, when interest rates fall, bond yields decrease. This inverse relationship is driven by the demand for bonds. Higher interest rates generally lead to lower bond prices, and lower interest rates lead to higher bond prices. Example, if the central bank raises interest rates, new bonds will be issued with higher yields. To compete, existing bonds with lower yields must decrease in price, thereby increasing their yields to match the new market rates. Impact of inflation expectations on bond yields. Inflation expectations can directly affect bond yields. When investors anticipate higher inflation, they demand higher yields on bonds to compensate for the erosion of purchasing power. This leads to an increase in bond yields. Conversely, if inflation expectations are low, bond yields tend to decrease as the real returns on bonds become more attractive. Example, if inflation is expected to increase from 1% to 3%, investors will seek higher yields on bonds to offset the anticipated loss in purchasing power. This demand for higher yields will cause bond prices to drop, thus increasing their yields. FAQs. Q1. What are inflation expectations? A1. Inflation expectations refer to the rate at which people, businesses, and investors anticipate prices will rise in the future. These expectations influence economic behavior and decision-making. Q2. How do central banks respond to rising inflation expectations? A2. Central banks typically raise interest rates to curb inflation. Higher interest rates make borrowing more expensive, reducing spending and investment, which helps control inflation. Q3. Why do bond yields increase when interest rates rise? A3. Bond yields increase with rising interest rates because new bonds are issued at higher yields, making existing bonds with lower yields less attractive. To compete, existing bonds drop in price, thereby increasing their yields. Q4. How do inflation expectations affect bond prices? A4. Higher inflation expectations lead to higher bond yields and lower bond prices, as investors demand higher returns to compensate for anticipated inflation. Conversely, lower inflation expectations lead to lower yields and higher bond prices. Q5. Can inflation expectations be measured? A5. Yes, inflation expectations can be measured using various methods, including surveys of consumers and businesses, market-based measures like break-even inflation rates from inflation-linked bonds, and economic models. Understanding the interplay between inflation expectations, interest rates, and bond yields is essential for navigating financial markets. By keeping a close watch on these indicators, investors can better anticipate changes and make informed decisions.